Today we'll be covering Learning Objective 2 from Chapter 6. Learning Objective 2. Understand how cost of goods sold is reported on what is called a multi-step income statement. To begin with, we're going to use an example from Best Buy to demonstrate the relationship between ending inventory and cost of goods sold. Assume that the store begins the year with a $20,000 inventory account for DVD players. That amount represents how much Best Buy spent to purchase the inventory of DVD players on hand at the beginning of the year. Throughout the year, the company purchased additional DVD players for a total of $90,000. The costs, the two added together, become total inventory available for sale. This is your beginning inventory of $20,000 plus your purchases during the year of $90,000 gives you total available for sale. So, of the $110,000 in inventory, one of two things happens. Either you sold it or you still have it on hand at the end of the year. Assume by the end of the year that the remaining DVD players not sold equals $30,000. The inventory that is not sold is your ending inventory amount. It's an asset on the balance sheet, and we're going to say that we did not sell $30,000. Well, we said inventory available for sale, one of two things happens. You sell it or you don't. So if you did not sell $30,000, that means the remaining $80,000 is what you sold, which is the cost of goods sold, an expense on the income statement. You will notice your ending inventory of $30,000 plus your cost of goods sold of $80,000 equals the total inventory that you had available for sale throughout the year. Again, inventory is a current asset reported in the balance sheet and represents the cost of inventory not yet sold at the end of the period. Whereas cost of goods sold is the expense reported in the income statement, represents the cost of inventory sold. If you remember, I've told you that every expense has the word expense in it except for one. That is your cost of goods sold. Don't forget that just because it doesn't have the word expense with it, it is still an expense. Now, this is a multi-step income statement for Best Buy. In the past, we've listed revenues, subtracted expenses, and come up with a net income. Here, you will see that there are different levels of profit. The first thing that we list is revenues. And our Best Buy lists revenues as one line item, net of returns, allowances, and discounts that we discussed in Chapter 5. Next, the cost of inventory sold is reported as cost of goods sold. Net revenues minus cost of goods sold equals gross profit. Gross profit is your first level of profit as shown in this new multi-step income statement. After gross profit, you see what is listed as selling, general, and administrative expenses. These are often referred to as operating expenses. Expenses that you incur in the normal day-to-day operations of a business, such as advertising, salaries, rent, utilities, depreciation, etc. You would list out each of those and you would have selling and general and administrative expenses. Your gross profit, in this example, $9,440, less your operating expenses gives you your second level of profit, your operating income. It measures profitability from normal operations of a business. It is also a key performance measure for predicting the future profit-generating ability of the company. Everything from operating income up is your normal course of business. So operating income being positive shows that they can generate a revenue, an income, a net profit from operations. After operating income, a company reports non-operating revenues and expenses. Best Buy refers to them as other income and expenses. These are the things that occur within a business that generate a profit or an expense that do not have to do with the day-to-day business of the company. For example, gain on sale of an investment. They had an investment in something and they sold it for more than they bought it for, so they had a gain. That's not Best Buy's normal day-to-day business. Investment income and other incomes, and then interest expense is often a commonly included non-operating expense. As you'll notice, since we're listing other income and expenses together, your income items are listed as positives and your expense is listed as a negative in parentheses. The third level of profit is called income before income taxes. When you take your operating income and subtract your other expenses and add your other income, you have income before income taxes. Lastly, a company subtracts income tax expense to find its bottom line net income. Income tax expense is reported separately because it represents a significant expense to the company. So your last level of profit is your net income. So, in review, revenues minus cost of goods sold is gross profit, your first level of profit. Second is your operating income. You take your gross profit and subtract your selling, general, and administrative expenses. From your operating income, you add any other income and subtract other expenses to get income before income taxes. Lastly, you subtract income tax expense to get net income. A multi-step income statement reports multiple levels of profitability. Gross profit is your revenues minus cost of goods sold. Operating income equals gross profit minus operating expenses and is a key performance measure for predicting the future profit generating ability of the company. Income before income taxes is your operating income plus non-operating revenues minus non-operating expenses. Lastly, net income equals all revenues minus all expenses and is your bottom line number.